Welcome to Wall Street Confidential. I'm Greg Greenberg. You know who this is Jim Cramer. Welcome.
Thank you, Greg.
All right, today we're going to talk about the end of momentum. Jim, is this the end of momentum as we see it?
What I see is that we have these periodic ends of momentum. Now, there's way too much money running the country to allow this to happen for very long. But we have had, and I usually judge it by the Investors Business Daily Mutual Fund Index. They usually pick the 30 hottest funds. And these funds were all up 5, 6, 7% already this year. I see profit takings emanating initially from the Real Estate Investment Trust, which had become amazingly the ultimate momentum game.
Was the Sam Zell deal the top?
I think for real estate investment trusts, yes, because these historically sold on a yield basis. And the average yield now is about 2.5% for this group, which is really absurd.
But here's the big question. You have equity office properties, all of a sudden it's taken out, and you have that dedicated REIT money, which has got to go back into REITs because people still think it's hot.
That's a very good point.
And there's not that many REITs out there. There's less than 200 or so.
That's a very good point. But I think that people are fickle. They jump from hot sector to hot sector to hot sector, and that there's a lot of hot money in REITs, and that money's coming out right now because the headlines all say the same. The issue is that there's no value buyers going to come in, or even traditional growth buyers at these levels, clearly overextended.
So where the valuation plays?
Well, what people are buying right now?
Yeah.
Well, I mean, I think that we're reverting to the Colgate, Procter, Kellogg traditional growth. Those are quintessentially safer. And I think that momentum money gravitates for the moment to safe. Momentum money will be back, but you see it in Google, you see it in the CME, you see it, money just pouring out of these things. And you got to let these things bottom before you come in, because one thing about the momentum guys, they will come back, but they like to take it off the table too. These are fickle, horrible buyers. They will outperform in up markets and just be dreadful in down markets.
Okay, you mentioned REITs. Now, REITs have had a huge run over the last 5 years, up about 30% a year, most of these funds. The other big thing was energy, and we've seen a lot of action in the energy market in terms of M&A over the past day, over the last week. What's going on there?
Well, Hanover Compressor, UCO, today, Hydro. These are all the exact same company. If you go look at their web pages, you will see they all do the exact same business. These have all gone into a tremendous multiple compression phase. They're growing at, say, 25, 30%. They're selling at 10 to 12 times earnings. Wall Street doesn't like them because they may have down quarters year over year. Main Street just says, okay, listen, the rig business is a multi-year business. Let's buy companies that make parts of rigs. I think that National Oil Varco, I think that Hydro, to a lesser extent, Dresser, Rand. I don't really care for that company. But these are all companies that are really on their butts, even though there's a lot of outside non-Wall Street interest in taking them over.
And you get the leverage there as opposed to playing an ExxonMobil or a Conoco.
Yeah, I think that those are without leverage. I think that's a very good point. Exxon seems played out. Chevron had a bad quarter. I like it because it's going from bad to good. Most of the integrateds need to drill more in order to be able to recover the reserves, hence the interest in drilling plays again, all of which have come down big, and therefore represent some value.
There's the value. That's also Jim Cramer. This has been Wall Street Confidential. I'm Greg Greenberg. Please come back. Thanks a lot, Jim.
Thank you, Greg.